Hello everybody, welcome back to EduTap. So as you all know that we are currently running a revision series for all those students who are attempting NPS Grade A and Grade B exam. So if you are someone who is looking for MCQs, if you are someone who wants to practice some high quality MCQs based on the previous year trends, if you are someone who is preparing for NPS and you are looking for quick revision, then definitely this series is for all of you. Okay. So today also we will try to solve as multiple MCQs based on multiple topics of finance. Okay. So let's start with this particular, I would say, session. First of all, if you are new to our YouTube channel, then please give a thought to subscribe to it, because definitely you will get a lot of quality content freely available on our YouTube channel. And yes, you can also join our Telegram channel. The link is given in the description box below. Right, you will get the PDF of this particular class on our Telegram channel only. Okay. So let's start first with the question number 1. But before I start, this is our plan which we are currently following. Jaskaran sir yesterday has taken the first class on finance. Today is the second class of finance which I am taking, and tomorrow will be the third one which will again be taken by Jaskaran sir. Okay, and then your commerce and accountancy classes will start. So let's start with the first question which is on the screen right now. The question says a bond is a fixed income instrument that represents a loan made by the investor to a borrower, typically a corporate or a government. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. A bond is a type of which kind of security? Is bond a debt security? Is it an equity security? Is it a quasi-equity instrument? Is it a swap, or is it an option? So what are your answers? Please let me know in the chat box. See, bond is basically a kind of a borrowing instrument. A bond is a kind of a borrowing instrument via which company raises money. And whenever we talk about borrowing, all the borrowing instruments are generally debt. Okay, so in finance you can borrow money either by two ways: by issuing equity or by issuing debt. Bond is a way via which company does the borrowing, and it's a debt security. So therefore your answer will be option number A, which is debt. Okay, quasi equity, swaps and options, these were just given to confuse you. Therefore the first answer will be option number A. Now let's move to the second question, and this all explanation is for all of you to read once you get the PDF of this particular class. Second question. A bond is a type of a debt instrument. Generally, when bonds prices go up, yield goes down and vice versa. But when bond prices go down, what movement will be seen in the interest rate? So if you see, bond is a kind of a debt instrument, but when bond prices go up, now when bond prices are going up, and yield goes down and vice versa. But when bond prices go down, and what movement will be seen in the interest rate? So can you answer this particular question? We all know that in bond there are multiple relationships which are important for your exam as well. So in this particular connotation, I hope you will be able to give me the right answer. Bond prices are negatively correlated to interest rate and to yield rates as well. So if you see, if bond prices are going down, your interest rate and yield will increase. Therefore, when bond prices go down, what movement will be seen in interest rate? Will it remain unchanged? Will it fall? Will it rise, or will it move sideward? What will be the correct answer? Yes, the correct answer will be option number D, because my friends, if you see in bonds, when bond prices are rising, interest rates, when bond prices are going down, definitely the interest rate will increase. Very basic thing. Okay, but if someone asks you the relationship between interest rates and yield, remember that there is a positive relation, but there is a negative relation between bond prices with interest rate and with yield. This is how you have to remember it. Okay, simple. Chaliye, now let's move to the third question, which is question number 3. Identify the types of bond wherein no coupon payment are made, but instead these type of bonds are issued in considerable discount to the par value, which leads to a capital appreciation for the investors. Perpetual, console, subordinate or superior. Perpetual bonds are those bonds in which maturity is not defined. So over here you cannot say that maturity is 1 year, 2 year or 3 year. Rather these kind of bonds are kind of like they do not have any shelf life, you can say. Perpetual bonds are also known as perp, and these are also known as your consoles. So in all the different types of bonds, your maturity is not defined. Subordinate and superior bonds are differentiated in the terms of repayment. Subordinate bonds are paid later, and superior bonds are paid, I would say, a step higher than subordinate bonds. So if there are two bonds, bond 1 and bond 2, okay, this is your bond 1 and this is your bond 2. This bond 1 is your superior bond and the second one is your subordinate bond. So whose repayment will be done first? Bond 1, because it's a superior, so it's like a hierarchy. Okay, but in this particular question, definitely the answer will be option number E, because the correct answer will be zero coupon bonds, which is not mentioned. Therefore the answer will be option number E. Zero coupon bond, for example, has a face value of 1000. It will be issued to you at 600, but by the time you complete its maturity, you will get face value of 1000 only. So indeed, you are just giving 600 rupees and you are receiving 1000 rupees. So you are having a profit of rupees 400, which is your capital appreciation. So therefore the correct answer of this question is zero coupon bond. Okay, cool. Now let's move to the next question, question number 4. If an investor further invests all the coupon amounts you receive at the same rate of return as of the yield, then you will get more return. Such yield is known as what? See, basically yields can be calculated in two manners: current yield and your YTM. Current yield is basically at one particular moment, like what is the total yield which you are getting. So over here the formula is what? Over here the formula is your current yield is equals to coupon amount divided by the current market price into 100 for percentage. Okay, but for YTM we have a different formula altogether, because over here we have two basic assumptions. In YTM there are two basic assumptions, right? First is that you will hold the bond till maturity and you will not resell it. Moreover, in YTM you will reinvest as in that whatever coupons you get, you will reinvest in the same bond. So these are the two assumptions of YTM. Because of these two assumptions, you will get a whole good picture that what is the total rate of return which you are getting in the bond. Okay, so the answer over here will be yield to maturity, which is long for YTM. Now what is the formula for YTM? You can see on my screen as well. Coupon amount plus face value minus market price divided by n whole to the divided by face value plus market price divided by 2. And this formula, according to me, is very important for your exam for phase 2. Okay, in phase 2 they can ask you a numerical based on this particular formula itself, because this is world famous. This is world famous in finance. So please do have some time to solve some numericals based on this particular formula. Next question is question number 5. There are various types of bond which are issued in financial market. In the same regard, identify the type of a bond which matures multiple time over a year for a period of time, and it can also be redeemed multiple times. Now this question has rather appeared in RBI Grade B Phase 2 2019. Now we all know that a basic bond matures only one time. Like for example, if you have purchased a bond of 10 years, you will get your face value at the end of 10 years. Okay, or at the end of maturity. But there is a serial bond also. Serial bond matures multiple times. Serial bond matures multiple times, and this bond is known as a kind of a serial bond because you are having multiple maturities. So the correct answer over here will be serial bond. Opposite of serial bond is known as term bond. Opposite of serial bond is known as term bond. So the correct answer over here will be option number A. Good. So as you can see on my screen, serial bond has multiple maturities, but only term bond has one maturity. Simple. Okay. Now for those who want to purchase our courses, these are the courses which we have launched for NPS. Phase 1, Phase 2 full video, Phase 2 full video. If you are looking for additional subjects like Indian Trust Act, statistics, pension, or data analytics, then you can go for additional subjects, Phase 2 test series and Phase 1 plus 2 test series also. Okay, so these are the courses. If you want to buy, definitely it's your call. Next question, question number 6. Blue bonds are the financial instruments primarily used to support projects related to what? Now we have green debt securities, right? In green debt securities, you have blue bond, you have yellow bonds, but the question is asking you regarding blue bonds. So blue bonds are basically those type of bonds which are generally used for water management. So therefore the correct answer will be option number B. Yellow bonds are used for solar energy. Yellow bonds are used for promoting solar energy. So the correct answer over here will be option number B. Okay. Now let's move to question number 7. Now we are moving to derivatives. Again, a very famous chapter of finance, derivative. A derivative is a risk management tool commonly used in transactions where there is a risk due to unknown future value. The term derivative is used to refer to financial instruments which derive their value from which type of asset. So under derivative, you derive the value from the underlying asset. Can somebody tell me how many categories of underlying asset are there? 1, 2, 3, 4 or 5? How many categories of underlying assets are there? Can you please let me know? How many types of underlying assets are there? Yes, somebody has given the right answer. 4 types. So you have your commodities, you have your equity shares, you have your currency, and you also have your interest rate. These are the 4 type of underlying assets which will definitely affect the value of your derivatives as well. So the correct answer over here will be option number C. There are 4 types of underlying asset, not 3. Okay. Chaliye. Now let's move to question number 8. There is a risk in the over-the-counter derivatives. Now over-the-counter derivatives are a kind of a private agreements which are generally forwards, and your swaps are over the counter, right? So there is a risk in the over the counter derivative because a party which is in loss might disagree to honor the contract. Such type of risk are known as what? These are known as your counterparty risk. They are also known as your default risk. Okay. Market risk is also known as price risk. Like the prices of one particular commodity can increase and decrease anyhow, right? So that is known as market risk. Interest rate risk is in the movement of interest rate. If interest rate collapses or increases, that can affect your investment. Legal risk is basically related to the laws of the land. Compliance risk is like you are not following the rules of the land. Okay. So all these are very basic terms. I hope you know. The correct answer over here will be option number C. Chaliye. Now let's move to question number 10. Identify the individual who bets on the derivative market based on his or her views on the potential. He is not actually interested in buying and selling the shares, but carries out the trade in anticipation of making profit. Now we already know that in derivatives you have 3 type of people. First you have is hedgers, second is your speculators, and the third one is your arbitrageurs. Hedgers are those people who want to play safe. These are the people who want to avoid risk at all cost. So if you are someone who is playing safe, you do not want any kind of risk element in your investment, then definitely you will classify yourself as a hedger. But in this particular case, they are not talking about hedging. Rather, they are talking about speculators. Speculators are basically those kind of persons who want to take risk. These are the people who will obviously bet. These are the people who will obviously think to get rich in just one night, right? So speculators are those people who are willing to take risk. Their risk appetite is far higher as compared to an arbitrator, as compared to an hedger also. And what are these arbitrageurs or arbitrators? These are the people who will buy and sell in different markets. Like they will buy one share at NSE and they will sell at BSC. So these are the people who are your arbitrators. As simple as that. Okay. Arbitrator basically have the potential to make risk-free profits. Like if I am buying at NSE for rupees 10 and if I am selling at BSC for rupees 10 and 50 paisa, then definitely per share I am having the profit of 50 paisa. So it's like risk-free profit. Moving ahead to question number 11 now. Question number 11. As the prices increases, the profit of the buyer increases and the losses for seller increases in the same proportion. Now we all know that in your futures and I would say forwards, if the current market prices is increasing, definitely our buyer is in profit and seller is in losses. One party profit, another party is having losses. This exactly is the concept of zero sum game. zero sum game. Okay. Similarly, when the prices decreases, the profit of seller increases and the losses of buyer increases. Now, if I say that the prices is decreasing, definitely buyer is in losses and seller is in profit, right? The profit and loss in the futures contract is also known as what? The profit and loss is known as, over here it is known as what? Can somebody give me the right answer in the chat box? I can see Sagar, look floor. What will be the answer for 11th one? Can you give me the answer for 11th one? The profit and losses in the future contract is basically known as payoff. It is known as payoff curve. Okay. So over here the correct answer will be option number C, not A. Paying off is not the correct term. The correct answer will be C. Okay. Payoff. Payoff basically is a kind of a future profit graph. For example, this is the profit graph for buyer. This is the profit graph for buyer. I can also call it as payoff. Payoff graph of buyer. As simple as that. Okay. So the correct answer was option number C. Now again, these are the courses. If you want to buy, you can definitely buy them. Question number 12. Identify the agreement where the agreement takes place between two parties to exchange sequence of cash flows for a set period of time. Usually at the time of contract is initiated, at least one of the series of cash flows is determined by a random or uncertain variables such as interest rate or foreign exchange risk. Foreign exchange rate. बताइए what will be the answer for question number 12? Question number 12, anyone? No. Payoff can be used for losses as well, my friend. Payoff graph is the term. Payoff graph is the term. Now, if one party is having something like this, the another party can have downward as well. So, I think it is used for both profit and for losses as well. Still, if you have any doubt or if you have any like validated source, if you have any important source, then please provide me the link. I will definitely verify it. Okay, you can provide the link in the comment section once the class concludes. Question number 12. Definitely over here you are exchanging the series of cash flow which only happens in your swaps. So the correct answer over here will be option number A. Futures. In futures you don't have series of cash flow, right? Identify the agreement where it takes between two parties to exchange sequence of cash flow at a set period of time. Now you are exchanging the sequence of cash flows. Usually at the time of contract is initiated, at least one of these series of cash flows determined by random uncertain variables like interest rate and foreign exchange rate. No, it will be swap according to me. Let me check it. Yes, the answer is swap only. Because in swap, you exchange a series of interrelated cash flow, whether it is based on interest rate swaps or currency swaps. Okay. Now let's move to the next question, which is question number 13. When one enters into the option contract, when one party enters into the option contract, one needs to pay around only 16 to 20% as upfront money to enter into the contract. This partial payment is known as what? So for example, the contract value is of 1 lakh, but you are just paying 10%, which is 10,000. This 10,000 is known as what? This 10,000 is basically known as your margin money. Now there are two types of margin money. You have initial margin and maintenance margin as well. I hope you know it. So the correct answer over here will be option number D. Upfront payment, partial money, less money, all of these were given to confuse you, but the correct answer will be option number D, which is margin money. And this entire concept is known as leverage. Leverage basically means that I will get the full piece of the pie, but by paying only the small amount of money. I will get the full contract value by paying only peanuts. So that is known as leverage. Moving forward to the next question, my friends, 14. Identify the type of an option contract where the option contract gives the owner the right but not an obligation to sell a specific amount of underlying asset at a specific price within a specific time. A buyer of this contract believes that the prices of share or underlying asset will decrease over the time. Now this question is asking you regarding options. Options are basically two types, call and put. चलिए बताइए 14. In call option, the buyer will make profit only if the current market prices are well above your strike price. But in put option, if the current market prices fall below your strike price, then also a buyer can make profit. In call option, you get the right to buy, the buyer side, or buyer is also known as the holder. In put option, you get right to sell, right? So over here, the option which you are exercising, owner the right to sell a specific amount, definitely it will be option number B. No, look floor, it will be B, because identify the type of an option contract where an option contract gives the owner the right but not an obligation to sell. Right to sell obviously comes in put option only. So let me check the answer. Yes, it's B only. So the correct answer of this particular question is B. But if I say you are getting right to buy, then in that case your answer will be call option. Okay, I am 100% sure that the answer will be B only. Chaliye, now let's move to the next question, which is 15th. Depository receipts are the financial instrument that represents the shares of the company but are listed and traded on the stock exchange outside the country. DRs are issued in foreign currency, usually dollars, but when DRs are listed on the stock exchanges of USA, these DRs will be known as what? So we all know that what is the role of depository receipt. Depository receipt is again an underlying, if you see, they have the underlying asset as shares. But tell me, please tell me the answer of what? Please tell me the answer of this. Okay, Malak is asking, please explain concept and the class cases of strike price. Okay, I will do it. But first, let's answer this question. If a DR is listed on USA, basically it will be known as ADR, which is our American Depository Receipt. It will be known as American Depository Receipt. But if it is listed outside America, then it will be known as GDR, Global Depository Receipts. Okay, so inside America it's your ADR, outside America is your Global Depository Receipts. And if it is the case of India, then it's your Indian Depository Receipts. Okay, now Malak was asking, explain the concept of cases of strike price. See, strike price, if someone asks you what is strike price is basically the price at which you purchase the option. It is the price at which you enter into the option contract. So for example, my friend, there are two types of option, call and put. Let's say that you purchase a call option with the strike price of rupees 100. You enter into the option contract with the strike price of 100, right? In the put option, let's make the same only. Again, you enter into the put option contract with rupees 100 as the strike price. Now, let's make one more thing very much sure, that we are talking about buyer. Okay, now buyer always pays the premium. Buyer always pays the premium in the option contract because buyer has the right. Okay, so assuming that the premium over here is rupees 10, which will be paid by buyer to the seller, which will be paid by the buyer to the seller. Okay, do remember, in both the cases the premium is rupees 10 only. Okay, now let's take one particular case when the current market prices are well above the strike price. So let's assume that the current market prices are 200. Current market prices are 200. So let's see that what will happen in the call option. If the current market prices are 200 and I have purchased the strike price of call option at 100, definitely my gross profit will be 200 minus 100, which is rupees 100 only. But I will also deduct rupees 10 because I have paid the premium as a buyer. So my net profit will be rupees 90. So my net profit in the call option will be rupees 90. But if the same case continues in the put option, will the buyer exercise the right? The answer is no, because in put option the current market prices has to be below strike price. But in put option, if you see the strike price over here is 100 and current market prices are 200, which means that your current market prices are above the strike price. This is not the profitable situation, so buyer will not exercise his right and he will allow the put option to expire. But he has to pay the premium. He has to pay the premium, right? So his total loss will be of rupees 10 only. His total loss will be rupees 10 only. Now, if I change the situation, let's say that the current market prices this time is rupees 50. If I say that the current market prices this time is rupees 50, so let's see what will happen. In the call option, I have already told you that you will be in profit if your current market prices are well above strike price. Okay, so over here if you see current market prices are 50, which is definitely not above the strike price, so buyer this time will not exercise the call option and his total loss will be limited up to the premium paid. But in the case of put option, definitely he will exercise the right, because the strike price is 100 and if you see current market prices are 50, which is well below strike price, so his gross profit is 50, but he also has to pay the premium, so he will do minus 10, so his net profit will be rupees 40 only. I hope thoda bahut whatever I could have done you would have understood it, but you also have to understand that options is that particular chapter which definitely takes a lot of time, but I have tried you to explain the overall story in a kind of a very quick summary. Okay, now let's move forward. The answer of this question was ADR, which is your American Depository Receipts. The next question. Question 16. In the stock markets, identify a kind of a special public offer which is used by companies to provide stability to price the share in the secondary market immediately on the listing of the shares. Is this known as cohesive stability, green shoe option, yellow shoe option? Definitely over here the answer will be green shoe option. Green shoe option में basically companies can allot more number of shares up to the extent of 15% for the next coming 30 days. So this is basically done to make sure that prices do not collapse immediately after the listing. Okay, and green shoe option is only validated up to 30 days. You cannot exercise it after 30 days. Okay. Moving forward to 17, the SEBI introduced the concept of anchor investor on 18 June 2009 to enhance issuer ability to sell the issue, generate more confidence in the minds of retail investors, and better price discovery in the issue process. The anchor investor will be qualified as a QIB, and then issuer can allot up to what percent of quota of QIB? Sorry. चलिए, question number 17. Now in an IPO we already know that QIB gets 50%, retail investors get 35%, and your non-institutional investors get 15%, right? These are the limits in your IPO. But in QIB there is one more category which is anchor investor. The question is asking you, out of QIB quota, what percentage of shares can be allocated to anchor investors? Yes, the correct answer will be 60%. The correct answer will be 60%, because if you see, if QIB quota is of 50%, then is 50 ka 60%. Then this allocation 60% will be made to QIB, and the minimum amount of investment by any anchor investor will be 10 crore of rupees. Do remember this as well. Moving forward to 18. In book building, the reservation depends upon whether the profitability or QIB route. Now, what percent of shares are allocated to QIB? This is just now we have discussed. The answer will be 50. Okay. So the correct answer is option number D. Okay, 15 is allocated to NIIs and 35 is allocated to your retail investors. Moving forward. Okay. Now, the last question, or I would say second last. National Stock Exchange was established in 1992. Nifty is one of the benchmark. Nifty includes your 50 shares, right? Sensex includes your 30 shares. So now the question is asking to you, what is the full form of Nifty? What is the full form of Nifty? What is the full form for Nifty? Yes, it's National 50. And what is the full form of Sensex? It's Sensitivity Index. Sensitivity Index, something like this. Okay, Sensitivity Index, simple. Moving forward to the next question. Moving forward to the next one. Okay, this is the last question for the day. In the stock market for securities, we have your depositories, right? How many major depositories are present in India? related to equities market, because now we have multiple depositories. But if you talk about equities market, how many depositories are present? Please let me know your answer. Yes, the correct answer will be option number 2. We have NSDL and we have CDSL. NSDL looks for trades on NSE and CDSL looks for trade on BSC. NSDL is your National Securities Depository Limited. CDSL is your Central Depository Services Limited. Cool. So the correct answer will be option number B. Okay, B. Now those who are counting on IIBX, which is your Indian International Bullion Exchange, that is for bullion depository, but my question was specifically related to equities depository. Therefore the correct answer over here will be B only. Okay, so that completes our lecture for today. If you have any doubt, then please ask, otherwise I will wind up. Tomorrow another class will happen with finance question, which will be taken by Jaskaran sir. Any doubts, any kind of question, any kind of, I would say, response, then please let me know. Otherwise, let's conclude. And yes, somebody was saying that payoff is only used for profit. You can share your source of information in the comment box. I will look to it. Any other question? Anything on which I can offer my 2 cents? Nothing? Cool. Is numerical important? For phase 2, yes. For phase 2, you need to have a command over basic to moderate. But like in commerce and accountancy, in your statistics, definitely numericals will come. Any PYQs for NPS? No, NPS is not, we are not able to generate any PYQs for NPS till now. We have searched a lot, but we are not able to get it. So do we know the portion of questions from each? See, in phase 1, 25 questions are dedicated, right? So you might expect 2 to 3 questions from finance, from management and from other subjects like in interest tax, 2 to 3 questions. But in your, I would say what, phase 2, you will get 50 questions. This is what we are expecting. Now you can get 7 to 8 questions from each subject. Okay. I hope that answers the doubt of CA Ritika Singh. Malak, I have answered. How to read Indian Trust Act? Indian Trust Act, either you can Google it, you can find some lectures on YouTube, or you can subscribe to EduTap course if you want to. But Indian Trust Act is definitely a long act to read. But I think on the freely available resources, we will be doing some MCQs on YouTube as well, so you can refer to that. But largely there is no, I would say, specific source wherein you can do your Indian Trust Act. Bond price numerical you can leave, that is not important, but just do some numericals of ITM. So that GA we will conduct marathons. For GA we will conduct marathons, don't worry. Marathons will be very much close to your exam, and you can follow CT 360, which is happening on YouTube regularly. That will help you. Okay. Chaliye. So let's wind up our today's class. Tomorrow again Jaskaran sir will continue this revision series. Now